Welcome back to the show. Today, we are unpacking a major trend in the real estate world. If you're an investor, you probably already know the acronym DSCR.
Oh, yeah, the Debt Service Coverage Ratio loan. It's officially being called the investor darling of 2025.
It really is. It used to be this niche thing, but according to a new report, it's gone mainstream. Lenders are finally comfortable with it, and investors are loving it.
So, for the uninitiated, why the sudden spike in popularity?
Well, Mark Halpern from Foundation Mortgage put it perfectly. He said 2025 was the year of greater acceptance. Basically, traditional income documentation is a headache for investors.
Right. With DSCR, they don't care about your W-2. They care if the property's rental income covers the debt. And with rents rising, that math is looking really good right now.
But here's the secret sauce. It's not just the lenders who are happy. It's the secondary market.
Exactly. Max Slyas-Sarchuk from AD Mortgage made a great point. He said the comfort isn't coming from the lenders. It's coming from the bond buyers.
That makes sense. Lenders just cook what the market wants to eat. If Wall Street wants to buy DSCR bonds, lenders are going to print them.
Now, I know what some people think. Non-traditional loan sounds risky, like 2008 risky.
Totally, but the experts are saying, chill out. These loans actually have really safe underwriting. We're talking higher down payments and higher credit score requirements.
Max actually noted that these are easier to underwrite because it's just pure math. You don't have to psychoanalyze a borrower's tax returns.
But do people actually pay them back? That's the big question.
Stacy Spees from Cornerstone Servicing says yes. She mentioned that delinquency rates on DSCR loans aren't materially different from traditional loans.
That is huge. So even though they aren't looking at your personal income, relying on the rental income hasn't proven to be a problem. It's performing well.
There's also a macroeconomic factor here. Interest rates are still making it tough for average consumers to buy homes.
Which means the rental market is on fire. Spies pointed out that as long as consumers are sidelined, we need landlords to provide rental supply.
So bad news for home buyers is actually fueling the stability of these investor loans. It's a symbiotic relationship.
Things are evolving fast, though. Jessica Vance, a broker out of San Diego, is seeing lenders get even more aggressive.
Aggressive how?
Well, usually you want a ratio of 1.0, meaning the rent covers the mortgage exactly. But she's seeing lenders do 0.8 ratios or even no ratio loans.
Wow, so even if the property doesn't quite cash flow on day one, you can still get funded? That opens a lot of doors. Jeremy Schachter from Fairway called DSCR the product of the year. He really highlighted the self-employed angle.
Oh, the tax deduction trap.
Exactly. You're self-employed, you write everything off to save on taxes, but then you look broke to a bank. DSCR bypasses that entirely. It's becoming the go-to for anyone with a complex tax return.
And it's not just niche lenders anymore. We're seeing big players like Rocket Pro capitalizing on this momentum.
Roby Robertson from LoanLogix called 2025 the proving out year. Basically, the industry dipped its toe in, the water was fine, and now they are ready to dive in.
It's moved from experimental to essential in a remarkably short time.
So, what's the outlook for 2026?
Growth, significant scale. Robertson expects institutional investors to increase their allocations next year.
Sounds like the DSCR loan isn't just a 2025 darling. It's going to be a long-term relationship. If you're an investor, keep your eyes on this space.